Fantastic. And now I have my lovely assistant read to you.
Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockwells.com, CSW, nor its affiliates, nor any of the respective officers. Personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involve risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. CSW provides education and training services that are meant to teach you to the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on the specific or identified day. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone.
Okay, that was exciting. So, how's it going, people? At some point, can you show your pivot point settings? They're not really settings, though. It's just a standard thing. Oh, look at oil. Damn it. Okay. We are still short oil, and at the moment, the overall position is amazingly showing a profit, but I don't think that's right. I'm sure I don't have a profit. My break-even is right about 53.59, so we're not too far from break-even. We hit, no, wait, that's not right either. I'm sorry. This would be my break-even, but now I sold 10, so my break-even on 20 would be there. My goal, I just got out of TAF over here because we expected a bounce. It bounced a little more than I liked. But as long as Brent stays under 56, if Brent gets rejected at 56, I can go back to having 20 short. So we're going to see what happens here. We'll take a look at it for a few minutes. The indexes are all down, coming about their lows of the day, so we'll see what happens to them. But they should be, this is a good support line, so we'll see what happens here. These are the pivot point lines that we were just talking about. And all I do is on the chart, you right-click on it, and you go to Studies, and you go to Quick Study, and it's a trend study, and then it's a P, and you see what? And then you go way down here, and it's pivot points. That's all, and you just add it to the chart. I don't screw around with the settings. I want it to be the exact same settings that most people use. Oh, so sorry. So it looks like we are being rejected here. I'm going to take a chance and add a few here. We're going to go 1, 2, 3, 4, and 5. So if he goes over 56, I'm going to get out. I'm going to get out of everything, frankly, if he goes over 56. But if he stays under, I'm good with that. So my theory was that we go back to 56, get rejected again, and we're going to make a W here and retest this low. So I got out of TAF, and now I can ride a 20 back down. What I'm doing is I'm raising my average by doing that. So I don't see that's a clear rejection yet, so I'm not too psyched to go to 20, and I also would like to have had 25 and not 24. But that's a little greedy. I think we're going to make it. Let's see how there's 60 of those and then 6 of those. There's certainly more people trying to sell Brent. So let's go with the other 5. So that was my plan, so I should stick to my plan. Lacking any reason not to, stick to your plan. Now, the NASDAQ's not too useful for oil, but we should look at the dollar, see what that's doing, in case it's doing anything interesting. And the dollar's coming up, but a little bit stopped, so there's no real pressure one way or the other on the dollar. And this is a very minor move. 104 to 108, and you're at 106. There's no movement here since yesterday on the dollar. Nothing significant. So we wouldn't worry about that. But this is very important, and this is serious money, so I'm going to watch this. We're at 20 short. I need that pink line to break, which is 53.20. And earlier, all right, now here's where I get killed, though, because I start talking about it and I forget I'm supposed to look at it. So earlier, we were talking in chat over here, and I did some bounce charts, so we can talk about that, because that's really important for this kind of trading. All right, here you go. So here's what I do. I always want to see different views. So I see when I'm trading intraday, I'm looking at this view. We were short all morning, so that was great. But you see the way it went down? It's like it goes down like annoyingly, like up and down and up and down, up and down. It's making progress, but it's annoying progress. That's still 60 cents is a fantastic move for a day. Even here, there's a choppy move. Look at the up progress. Oh, geez. That's a gift. It barely went down the whole way up. Anyway, so on the move, so what am I saying? I'm saying we know 50 is a big baseline for oil. $50 is the line, the key point. It's a must-hold line for oil where you're bullish above it and bearish below it generally. So off the $50 line, and I wrote all this down for the members down here in this part, but off the $50 line, so I'm watching this to confirm the move. So what's the top of my move? It was 53.75, okay? And I see it over here, and I want to confirm it on a bigger picture here. And it's not, and you see it's not quite 75, it really only hit 70, but that means it's rejected at 75 because oil moves in 25-point increments. So, and also now I say, well, that seems like a 53.75 should be right, but do I have any reason that 53.75 is significant? So, yes, I do, because look, if I take the 5% rule, 50 and 5% is 52.50, and then 5%, and then 2.5% of that, a 2.5% move after that. So if it's rising but it's decelerating, it goes to 52.50, and the next thing would be a 2.5% move to 53.75. So on the button here is the 7.5% line. So that means I can look at a couple of things. I can look at the move from 50 to 53.75, and I say, well, what kind of rejection would I get from that? That's a 375 move. 20% of 375 is, I don't know, 75 cents. There you go. 75 cents. So we're looking for a weak retrace. A 20% retracement of a 375 move is going to be 75 cents. So 75 cents obviously goes back to $53. And notice how perfectly that worked out. We actually got an exact retracement to 53. That's a weak retracement. Now, from the weak retracement, if we want to know if it's going lower than this, from the weak retracement to 53, now is it going to bounce strong or weak? Well, now we have a 75-cent retracement. That means 15 cents is a weak bounce. And look what it's doing here. 15 cents is a weak bounce, and it's having trouble at the 15-cent line. That's very encouraging. Although that's not true because I'm looking at the chart now. That's not live. This thing is not live. On Thinkorswim, though, I'm going to be looking for 15 cents weak and 30 cents strong. And here you go. Look at that. On the noggin, 30 cents. So, you can totally tell the 5% rule is working currently. All right, so that's very encouraging. If you see the 5% rule working that well, it means you're probably in good shape. Come on. I'm going to do this on my other. I got another camera for this too. So. Wow, won't even give me an extra penny. You bastard. So in other words, as I'm telling you this, I'm seeing it's working so well, I should put it on my other account too. So now I just shorted that too. So anyway, so the point being that it's doing exactly what we expect it to do on a bounce. So in other words, I don't see this as a failure of the downtrend. I see this as a perfectly normal, strong bounce off of a big move down. So what we're going to look for now is the next significant line is 53.15, which is the weak bounce. If the weak bounce fails, we're going to come back and test 53. And I believe 53 is going to fail, and we're going to see 52.50 again. And if I see 52.50 with 20 contracts from here, that's $15,000. So I'll be very, very happy. So that's our goal right now. We're hoping to make $15,000. And we'll see if it works out. All right. Can't possibly be any questions. That has to be clear as a bell, right? Let's see. TF 1360 is strong support, absolutely. Take it to 1365 and then add, hope it gets short. Well, let's look at 1360 also. I know oil is risky, but see, okay, Syria doesn't have any oil. To me, right now, the overriding thing driving oil is the rollover of the NYMEX contract. There's too many open, excuse me, holy cow. There you go. Too many open contracts. So the contracts expire 3 trading days before the 25th. So 1 trading day, 2 trading days, 3 trading days before the 25th. That should be the last trading day. That means they have 1, 2, tomorrow's a holiday. I mean, Friday's a holiday. They have today, tomorrow, and then they have 4 more days. So 6 total days they have to get rid of all their contracts. Now, the NYMEX, what's the name of that site? Futures.tradingcharts.com. Okay, let's try that. Futures. Oh, it knows it. Let's see how that works out. No. Wait a minute. What did you wrong? Futures. Oh, futures.tradingcharts.com. Aha! That is it. Oil and energy. And crude oil on the NYMEX. Fantastic. There we go. All right. So we said including today, 6 days left, they have 287,000 contracts to get rid of. So that's 287 million barrels. There's already 468,000, which is crazy, in June. So they have to roll these barrels out. They're not going to find actual buyers, frankly, out of this price. They got to roll these contracts out to the longer months. It's going to cost them money. They're going to have to pay 39 cents to go the next month. So they're going to have to pay up for these rolls, but they'll do that. That's 39 cents times 200 million barrels. It's not like chump change. So what we're looking for here in the next 6 days, 6 sessions, is you're looking for if they're getting rid of a lot or a little barrels. Now, yesterday they had 300 million open, and they only got rid of about 13 million. So that's terrible because you have to get rid of 40 million a day and you only got rid of 13. You're doing a terrible job. That's showing a big problem for them, and that means the pressure is mounting. And at some point, there'll have to be some sort of capitulation, and the capitulation usually will result in one big sell-off. Like suddenly somebody tries to dump a bunch of contracts and it causes a huge problem. You can see the volume here. Look at the volume is double. The volume is almost double the amount of open contracts. So they are churning these things like crazy. They can't get rid of them. They're just churning them inside the same month, but they're not really getting the numbers down. I mean, so they're like playing hot potato with the contracts because nobody actually wants these. When this is done trading, there will only be probably less than 15,000 open contracts. So 270,000, 280,000 of these are what we say is fake contracts. It's just a trading vehicle to jack up the price of oil. It has nothing to do with supply and demand at all. They trade, look at this volume, 400,000. They will end up, understand that, they will not end up, see the 34,000? They're not going to end up with that many. They're going to end up with half of that many contracts for the entire month. And yet in one day, they trade 2, and then 10 more, 20. They trade 20 times. No, it's actually 20. It's actually 30 times. They're trading 30 times the amount of contracts that will actually be delivered in a single day. This is sick. It's a complete and utter scam. It should be banished from the face of the earth. But we can make a fortune on it, so we'll enjoy it while it's there. All right, anyway. So, knowing it's a scam, we know the mechanism of the scam. So, in other words, when there's too much open interest, these have to go. There's nobody taking delivery of these contracts. They are going to go. So July is a good month, though. So they're going to probably stuff a bunch of contracts into July and anticipate some better demand. Even so, though, even in the best month, they're still not going to take more than 30 million actual barrels. That's just the 30 over here, no one. So it'll be 30 million actual barrels. But even in a huge demand month, that would be the most they would ever accept at Cushing. And plus, Cushing is full. Oh, wait, we have a chart for that, too. I was on fire with my charts today, wasn't I, guys? Okay, here you go. Might be hard to see for you guys. Control +++. Oh, wow. Okay, here's Cushing. So you see how Cushing, Oklahoma is building and building and building? Now, there are competing theories on Cushing. For some reason, nobody knows how much it really holds. Theoretically, they say it holds 90 million barrels, which means they're good. But realistically, they really seem to run into huge problems when they get up around 70. So historically, look, I mean, look at 5-year average. It doesn't actually happen. They've never actually had this many before. So 65 million has caused many crises in the past. And they've had to get rid of oil from Cushing, Oklahoma. They've been backed up in problems and whatever. They're just not equipped to handle that many barrels of oil. And so now we're testing new record highs in Cushing. Because understand, this is a 5-year range. It never went higher than this in 5 years. And not this early. So they got big problems there. Overall, though, total inventories, as you see again, we are blasting through record highs. Gasoline's coming down. We're getting a bit of a draw on gasoline. We're getting a bit of a draw on distillate, coming back into a normal-ish range, but the oil is still way too high. All right, refinery demand is moving up. But this is also rollover season. So you always spike this time of year because of the rollover from diesel fuels and stuff. They change the mix in the spring. Imports down, imports are down the low end of the range. Total imports are right in the range here. Exports are obviously blowing away from the highs. So we're exporting a lot. Even though we're exporting a lot, we're still building and building and building. So where was I? Oil, right. So way too many contracts. We expect there to be continued pressure on the NYMEX, and that's where the overriding trade is. Understand that trade only lasts until we get a good blow-off down. So when we get a nice dollar move down, we're like, okay, fine, that's it. Because you can't, at that point, you're really nitpicking to figure out if there's still pressure or not. But what we see here is that there is pressure, and we have not seen a pressure relieving event. So since we haven't had a pressure relieving event, we anticipate one happening at some point. And that's not, well, I'm sorry, that would be enough. That's not it. This is not enough. We're talking about like a big, something like this, but a really big drop, like maybe more than $1, like $2, something like that, a big drop. And you know, yeah, we are prone to those. We have one here, and we're having one now. We're having a nice drop now. I think this might do it, though. I think this might take us to 52.50. I think we're just bouncing off that 53 line. Once we fail that, it's clean sailing down to 52.50 and maybe lower. So we will see. It's going to be exciting. It's kind of exciting trades. I'm really into it. I like these when they work. I like them when they work. Duh. I don't like them when they don't work, but I do like them when they do work. So we'll see what happens. Yeah. Okay. Oh, no, that wasn't the right button. That one. All right, whatever. So at the moment, the forefront concern for oil trading is going to be those contract rollovers. Now, it can get trumped, if you will. It can get trumped by some blasting news in the Middle East. But really, all we're doing is, first of all, Tillerson's over there talking to Putin, so it's highly unlikely anything serious will happen while you're having diplomatic discussions. It would be really poor taste. Not that I put that past Trump, but it would be really poor taste to actually take action while your Secretary of State is over there discussing, you know, what to do in the future. The same goes for China and North Korea. It's like we're not doing, you know, you can posture all you want, but we are not doing anything in North Korea unless China lets it. That would be suicide for us. Start having troop movements with China. Oh yeah, we're going to look at the Russell. So, along that vein, we didn't look at the Russell. Oh, look at that. All right. So in the Russell, you want to get a big view first. So you start with a big view, and we know that this is okay, I can show you, in fact. Okay, here. So the Russell 200, that was 1999. It's a longer-term chart that I was thinking. So the Russell basically, in 2008, the Russell bottomed out at 200. But really, basically, what matters is it got back to 600 nice and quickly. So we call 600 the baseline here. This is an aberration. This whole thing is an aberration. The real baseline was 600. It's moving up in 200-point moves. 200 is obviously very solid support. So in 2, 4, 6, back to 2, back to 6. It didn't bother stopping at 4. Back to 4, almost a little bit of a retrace, an overshoot, back over, and now it's decided, okay, yeah, 6 is where I'm basing. So the base we know is 6. Now 100% move from 6 is 12. So then we know 12 is very significant. It's a fact, right? Obviously, if we started. So we know we're moving in 200s anyway, and we move from 2 to 4 to 6 to 12 is a doubling, and everything doubles, so that's okay. And so 12 is the base we're currently working off. The bullish base is 12 for the Russell, and that's what we call our must-hold line. So from there, we do our 5% calculation. So, Mr. Calculator, there's one. And we say 1200 times 1.05. So now we know 1260 is a 5% move. So now I know 1260. So if it's 1260 is 5, then 1320 is 10, and 1380 is 15%. So now I know that 1380 in this area is going to be my most significant line. So now I go back to a daily move, and I see where does 1380 come into play. And you see here, other than this little bit here, which is, you have to ignore things. If you know your line's 1380, and you look at something like that and say, well, it went over 1380, but then it got back to 1380. And what's your next line over 1380? Next line is 1440. Never made it there. And in between will be 1410. That is where we capped out. So so if this is a 15% line, 1410 would be the 17.5% line. Not as significant, obviously, but the point is that's a little bit of an overshoot. It's not a big deal. So what matters here is 1380. So when the Russell moves, we're looking at 1380 for any kind of basing that we're going to do. And the line below 1380, 60 points below, is 1320. And we haven't hit that in a long time. So if you haven't hit 1320 in a long time, take the 30-point move. So half of the 60-point move, take the 30-point move. And what is 60? 60 is 5%, 30 is 2.5%. So 1380 to 1350 is the zone we're going to be in since we don't see the moves outside the zone. And as you can see there, and as is very obvious here, 1350 to 1380 is the range we're playing. Isn't that easy? And there it is right there. So when you're doing your math on the 5% move, on the 5% rule, and it all works out as you zoom in and zoom in and zoom in, then you say, okay, I think we're really on to something here. So we know the moves at 1380 to 1350. Now we calculate the bounce from that. So that's going to be that's a 30-point move. That means your bounce is going to be 6 points. So 1356 is significant, and 1362. Oh, look at that. 1362 is a strong bounce off 1350. So if the strong bounce at 1362 begins to fail, that means that your strong bounce is failing here. Even though we didn't get to here yet, the line's still come into play. So remember we got 1356, you see this? We hit the weak bounce. That was strongly rejected, the weak bounce. It's confusing. It's a weak bounce off 1350, which is a phantom move, which we never got to. But if we had gotten to 1350, the weak bounce would have been there. So by bouncing off that here, it's just confirming that's the weak bounce. Then it made it to a strong bounce line at 1362, one bit over also. And now it's checking the strong bounce line at 1362. So it's like like a dome sort of across this thing. And it's going to probably play along this dome. And, well, again, because of my general market bearishness, I think it's going to fail, and I think we're going to plunge back down to 1360 for sure. Oh, well, we're at 1360, so that's silly. Wait, where do we start? We started, 1260, 1320, there you go, 1320. 1320 and 1360. So 1350 is between 1320 and 1380. So 1380 and 1320, which is way down here, and 1350 is dead center on that. So that line's going to come into play. And if that fails, if 1350 fails, I predict 1320. And 1320 is 40 points below here. So from this spot here, 40 divided by 1360 is 3%. So basically, we're looking for a 3% drop. So then when you know you're looking for a 3% drop, you can then apply that to TZA. You multiply it by 3 because you have an ultra ETF. That means you're going to get an 8.89% gain in TZA. And so if I'm predicting a 9% gain in TZA, if I wasn't going to play the futures, although why wouldn't I? But I could go to TZA, which has the Ultra, TZA, and I think it's going to happen sooner than expiration, which is next Friday. All right, but maybe not. That's a little dangerous to play Friday. Let's think about that. We could play the Friday. Okay, 18 plus almost 10% is another $1.80. So that's going to be 1950, about 2050. So we're looking for a move well over 20. That means if I buy these 19 calls, well, I don't like to pay premium, so I'm not going to do that. I could buy these 18 calls for $1.05. That gives me 9 days, and they're pretty much in the money. So any kind of move in that direction. Now, if we end up at 2050, these things are going to be worth 250. That's a big jump, right? That's a 150% move in this call. Now, so the question is, for a little bit more safety, do I want to go to the May? And now the question is, how much more do I have to pay to be in the May 18th? And the May 18th are way more expensive. I'm not happy with that at all. May 18th are 160, 179. So let's say that's 170. So those are 170. I don't think, why would I pay 170 instead of 105? Why would I pay 65 more cents? Now, you could do the weeklies. I don't like the weeklies because they're not as liquid. I would say yeah to this. I like this trade. So my trade idea here would be to buy the April 18 calls of TZA. That's the ultra short Russell, and our target on this is 20.50. But you know, you don't know you're going to hit that. So if you make a little bit of money fast, I would take some off. So let's say you do. Let's say you want to hold 10. I would start with 20. I know that sounds weird. I would start with 20, and as soon as I make a quarter, I would take 10 off. So then you've reduced your basis by 25 cents on the 10 you have left. You understand that? So in other words, if I buy 20 and they all go up a quarter, and I sell half for a quarter profit, that means I've reduced my basis from 105 to 80 cents on the 20 I have left. You're still at 130. I'm sorry. You'd still be at 130. That's right. You'd still be up a quarter at 130, and your profit would now be entirely resting in the ones you have. Then I could lock in that profit by selling the call. Like I could sell the 1950 calls or the 20 calls and lock in the profit. There's lots of things you can do, or you can just take it off the table to quick profit. But either way, that's a fun play. But that's, by the way, that's if you can't play the futures. If you can't play the futures, play the frickin' futures, because that's much more fun. You can set much tighter stops. So as to a stop, obviously, and while I'm talking, it's going up. Or what the hell is it, dude? Why is it like all over the place? I'm out of the screen. Oh, next week I'm going to try to show you this cool news app I have too. I'm going to put it on this machine. We're making a deal with these guys to make it available to our members. It's like a high-end news app. Very cool. Anyway, sorry, bottle cap fell. So I would probably put a stop at 1365. So that would still go for the, if you're playing TZA, the same stop would go. If I see 1365 on the futures, I want to get out. But as long as we're under 1365, I think we're probably good, and I think we're consolidating for a move below. Remember, 1362 was the strong bounce line. So you could actually put a stop at 1363 and keep it tight. And these are $10, no, I'm sorry, $100 per penny? No, it can't be. It's up. I forgot. I swear. You know, because they changed the Russell. I'm all confused. They changed it. It's 5 now, right? So I don't play anymore. Yeah, $5 per tenth. So that means every one full point is $50. So it's 50. It used to be $100 a point. Now it's $50 a point. So I was just double the amount I want to get anyway. So where are we? Oh, I didn't have the Russell up. Okay, dollar is strong. That's good, or strong in the strong end. The S&P's down, and these guys are down. Where did I come back in? About 24, right? So I made a dime, made $1,000. But you know, it's only $1,000. But on the other hand, if it's coming back up, why should I not take my $1,000 off the table? But I expected better. I expect to do better. It's hard though because the NYMEX is closing in an hour. All right, let's see. Russell. All right, so what do we say we want to do? We want to short it below the 62 lows. So before I do any of that, though, we should definitely check the news and see if anything exciting is going on. You know, before you start making all these, you know, like, oh yeah, I'd love to do that, but meanwhile, I don't know what's changed in this amount of time. News, right? Okay, now I don't have a. So let's take a look at King Alpha. Seeking out for exploit the SEC's actions to stop out stock promotion. They're the ones that have all the people who are doing it. Oh, they're so funny. Market news. Now, why is it so ugly? Oh, that's why I can do all. Here we go. All right. So what have we been missing? Nothing. U.S. Steel leaks toxic chemicals. Well, that's legal now. Why would it go down? The EPA is not going to care. So U.S. Steel, they potentially has this leak. When the EPA is reporting something. The leak of wastewater containing the chlorine toxic compound causes lung cancer, damage to the eyes. Wow. The EPA sees no sign. Okay. But the EPA is not worried about it, so we shouldn't be worried either. All right. It's only for people who live near Lake Michigan. Otherwise, don't worry about it. Steel share swoon at Korea steel dumping ruling seen as not enough. Okay, so we put a ruling against Korea for dumping steel, but it wasn't that strict, so people got upset about that and steel went down. Santander and Portugal settled talk. Oh, settle. That's okay. That's good. Indonesia eyes truth with Freeport. Yeah, they're having a big fight about the payments and mining rights and so on and so forth. Most bond funds lag the market. How'd the auction go today? Oh, we need to wait. It's 1 o'clock. I don't know how the auction went. Consumer top gainers and losers don't care. Short bets pile up on 7 stocks. None I care about. Oh, STYP. We have STYP. People don't believe in the rally. Ultrapolating exit bankruptcy. Plug Power down. Oh, Plug Power. Oh. But it's just a dilution thing. That's okay. Let's choose Steel Shift. Said that already. Square. I like Square. These are going to buy. Oh, come on. There's all this takeover talk. This is, by the way, one of the things that happens in a late stage rally. To keep the rally going, they float tons of rumors about takeovers that never actually pan out. Chevron and Exxon messy earnings. That would not be good because I think they were counting on the oil sector to have good earnings. And here's the oil inventory. So now we're all the way back to 1030. So nothing has happened. Caterpillar enthusiasm overly bullish? I think so. It's a little bit too high. Atlanta Fed's read on business inflation falls back, so there's less inflation means the Fed has more room to keep an accommodative policy. Walmart's coming after Amazon, which we're short on Amazon, so I hope they kick their ass. All right, so nothing has really changed. So now we go back to the boom, and we're back at 1362. And I'm not going to short while it's going up, am I? I'm going to wait and see. Let's see what happens here. If we start failing 1362, I'll short a couple. Oh, all right, apparently we are. Oh, you kidding me? As soon as I put my offer in, it falls below it. Hate that. Look at that, these bastards. I got one. All right, let's see if we can get another one. There we go. Now I got two. Now I'm worried that won't fill too easily. Some people are never happy. All right. So, as I said, we got 1362. Certainly by this line, 1365, I'm going to bail if it's not working. But that's going to be a loss of, I believe, $300 if I get to that point. I'm doing my math right. So hopefully we don't come to that. But in theory, I think, well, look at the dollar. See, the dollar's moving up sharply. Something's happening. Check my news app. Hang on a second. As I said, I have a cool news app that we're testing. It's still Stock World. And it's going to tell me what's going on. Tesla's down, who cares? It'll drop 10%. That should hurt the market. They update stock features, geopolitical concerns persist. This is a great app, I gotta tell you. Like $70 a month is really, really good. It's not an app. In fact, it's like, unfortunately, it's not even a web page. That's why I can't show you. You gotta download it. But man, we have some good news. Nope, nothing there I care about. Yeah, I care about. No, I see nothing. I see no news that would make this market bouncy. All right, so that means I'm going to stick with my. That means that makes me more determined to stick with my entry. There's no reason for this. Okay, I think all we have going on here is we're marching into the 9x close. He's back to 53.20. I said I was going to get out if we go over that line, though, right? So we're watching that. And here's Brent. Brent's not rallying though. We're still under 56 in Brent, so this seems like bullshit to me. Let's see what the other charts look like. Everyone's just moving up a little bit for no particular reason. Natural gas coming off a nice floor at 315. That was a good trade. That would have been a good trade if we caught that one. Nikkei, now he's really lagging. And if the dollar's getting stronger, that's a good long. Well, look at coffee got murdered. Wow, we had a nice high today and then it got murdered. Silver, gold, dollar. I see no particular reason for any of this stuff happening. I imagine the catalyst must be the 30-year auction must have gone well. Probably a bit of relief from that. All right, let's see what you guys have to say. Let's get back to this. Oil is getting risky with, we said that. Westinghouse bankruptcy is a big issue for CBI. I don't think so. I mean, it's part of their business, but I don't think it's a big... Look, bankruptcy isn't always a bad thing for a supplier because they still operate. They're not like, it's not like they're going to abandon all their nuclear reactors and stuff like that. It's like the work still has to get done. They've got massive multi-year projects in the pipeline. What they do is they go to bankruptcy court and they sell it off to somebody else who funds it. And the nice thing is that somebody else, though, will then have the money because they're buying it for so cheap. So in other words, if I'm in the rental business, like if I'm in a house rental business, like I'm an Airbnb guy. So if I have to buy a house like my house for $500,000, then I have to rent it out for, let me think what the mortgage be on that. Say if it was $500,000, probably be paying a mortgage and taxes of, let's say, $5,000 a month, just for rough figures. So if I have to pay $5,000 a month for my mortgage and I've got utilities, I'll say another $1,500 and all my expenses, $7,500 a month. That means if I'm going to rent it out for 30 nights, which I'm not going to get 30 nights, so I count on 20. Then to get $7,500, I would have to get $150 a night. Is that right? 20? No, that's not right. Ugh. This is the easy math. I should be able to use my head. My brain is fried. 7,500 divided by 20 nights, $375 a night. So if I want to rent my house out profitably, I want to rent it for $375 a night. Now, but if I bought the house in bankruptcy or I'm saying any asset, doesn't matter, I'm making it easy with the house. But let's say I bought this house for $250,000. Now, it doesn't change my expenses, but it changes my mortgage, and say my mortgage is $2,500 now instead of $5,000. My expenses are the same, so basically now I only need to clear $5,000, which is $250 a night. So I can now run a profitable home business for $250 and rent it for $250 a night versus the guy who had it in the first place who had to charge $375 a night to do the same break even. That's what bankruptcy is. Bankruptcy is not bad for the suppliers because, right, is my electric company upset? No, I'm paying them. In fact, I'm more easily able to pay the electric bill and the other bills for the house whenever we calculate those in. So I'm easily, and the taxes on the house, I'm paying everything off. I'm paying the bank mortgage. Everything is being paid because I've got a better deal than the first guy. He took a loss. His shareholders took a massive loss. But that's not really a problem for the people who supply it because the asset they're supplying still exists and still is a workable asset. So I hope that was clear. Rounded out example. Thoughts on auto companies with used car prices tanking and subprime car? Okay. Used car prices are tanking because everybody's buying new cars, and nobody wants a used car. New cars are cheaper, better deals, have cooler electronics. This is the thing, by the way. There's going to be a long-term problem with used cars. So anybody who specializes in used cars, I'd be very careful about it. Cars are very electronic, okay? Getting more so every day. So nobody wants an old car. Like my kids get in a car and they expect certain things. They expect USB ports in the car. And if they don't have USB ports, they don't think it's a good car. If it doesn't have a good sound system, they don't think it's a good car. They don't care if it doesn't have a video because they've got a video, that's their phone, but they better damn well be able to plug their phone in. More and more, my kids are saying to me, they're like, I'm looking for another car. I've been looking for another car, so I'm giving my car to my daughter. So I'm looking for a new car, and my younger daughter, who's going to still ride with me, she's like, "Can we get a car with Wi-Fi?" So Now it's like you need Wi-Fi in the car. This never happened before with cars. It used to be a car is a car. I mean, yeah, they would upgrade them a little bit and whatever. But, when I was a kid, a 10-year-old car was as good as a brand new car. There was no difference really in the cars. Now, because of the electronics and how fast they change, a used car is not a good car anymore. It's not desirable to younger people. All right, that's number one. Number two. So used cars on the whole are on the outs in desirability, and it doesn't mean you can't ship in other countries either, because kids are just as smart in other countries. It's not that easy. So the value of used cars is going to go down considerably and stay down. That does not make the new car business a bad business. As to the subprime issue, you've got the whole car business is going to blow up. More of the self-driving things can destroy the car business, not anything else. Because then then kids are going to say, I don't need a car. If I want a car, press a button, a car comes. Then why would you have a car at all? And since it's much more efficient, probably there'll be like 1/3 of the amount of cars that there are now being sold total. That's when they're going to have problems. But we're years away from that. And of course, there'll first be a boom in selling the self-driving cars, and then there'll be a bust. Tanking subprime. Okay. As to the subprime auto loans, a subprime auto loan is nothing like a subprime home loan because you don't get leverage up your ass for a subprime auto loan. And people will give up their homes sooner than give up their car. Okay, because you can be homeless, but you still need to go places. So it's not an easy thing. People are going to make those car payments. Plus, if you don't make a car payment, they take it away. If you don't make a house payment, you can live there for like 3 years not paying your home. You can't do that with a car. If you don't pay your car for like 3 months, they will come and take it. It'll be gone. So subprime auto loans are not as big of a deal. There's an actual asset you can take without a major legal hassle. Okay, it's a very clear-cut thing. Taking a car away from somebody is something that you can easily do if you're the creditor on the car. So, although there are more subprime loans and there are more loans that are in debt, there are more loans in default because there are more subprime loans. I mean, they've just really pushed the boundaries of who they'll lend to. That it's not necessarily a bad thing. They make a big deal of it in the press, but I think it's a story that's looking for a problem, but there's no actual problem with it. Certainly not so far. Paul Fisher, I'm very happy you gave me your password, but I'd like to know what it's to. Where do I go? What do I get? Ow! What's going on? So you're going up, and you're going up. Here we are at 64, so we're pushing the boundaries here. Now, I don't know why it's going up, but since everybody's going up, it's probably not a good idea to stick with the Russell bet. And oil, we'll see what happens, waiting for the NYMEX to close, but I'm probably going to have to get out of this one too if it keeps moving. Where are we? Wait, what was that number? Somebody gave me a secret number. Where it's up to. Where'd you go? All right. So CO rejected at 53.25. Where would you look for a further retracement? Okay, well, that goes back to the thing. We're looking for 52.50 is the key line, right? 52.50 and 53.75 oil. And oil. So, well, I can't see 52.50. 52.50 and 53.75 are the key lines because that's the 5% line, the 7.5% line. So the drop from 53.70 to 52.75 to 52.50 is $1.25. If it's $1.25, your bounces are 25 cents, right? So 20% of that is going to be your weak bounce. So from 52.50, 52.75, and 53 are your next key lines. 53, right here, is a strong bounce off 52.50. So if we had completed the fall, we still would have bounced to this point, most likely. Still would have had a strong bounce at some point. We didn't complete the fall. We bounced off the strong bounce line, but now we have to calculate 53.75 to 53.75. That means 15-cent moves, 53.15 and 53.30. And really, as long as we're under 53.30, we're probably just consolidating for a move below this line, 53, which is a strong bounce line off 52.50, and also every 50 cents in oil is serious support anyway. And you can see it over here. See how 53.50 becomes important? Any 50-cent line, even 25-cent lines in oil are always significant, but especially 50-cent lines. So with the 5% rule, that's all you're doing. You're just calculating. It's got nothing to do with TA. It's just a math bit. All you have to do is find your base. Then you calculate 5%, 2.5%, and 1.25% lines from there. And that's when it starts to look like Fibonacci lines. In fact, how close of a shot am I going to be able to get in this thing? Let's see. Do this real quick if I can. I don't know if it is a quick thing. Oh, no. I know if I do that, it's going to crash. Sorry, can't do it. Because it loads some kind of flashy Java thing. And yeah, I was going to show you how I can draw Fibonacci lines, so that's going to be a bad idea. It's going to almost certainly crash out. But anyway, it's like a Fibonacci retracement. So, but it uses 5%. And the reason we use 5%, for those who don't know, my dad used to design the original trading programs at the banks back in the day, in the 70s and the 80s. My dad used to design those systems, the original trade bots, the ones I bitch about all the time. and I used to go with him and consult because I spoke banker and he spoke data. So, he was a systems analyst. So I would sometimes, go to the meetings and have a conversation with the bankers so we could figure out exactly what they want, and I would translate between the programming staff and the banking staff. And what I realized in going to these meetings with all these big banks and seeing the systems they want to design, the banks and brokerage houses, all these guys, they're all trying to design trading systems to beat each other. But the reality is computers, first of all, you have to understand there's no such thing as a random number. Okay, a computer uses a random number generator, but those random number generators follow certain mathematical rules that mean they're not really random. I mean, but you'd have to know what they're sequencing to know what the numbers would be. So it's not like you can guess the random number. But the point being that anything a computer does is going to end up in some kind of increments in programming. And what I realized is that when you talk to people in these meetings, everybody's got they say, well, how much variance do you want? Like, when would you like this to trigger? And they'd always pick a round number. Oh, I want no more than a 1% loss or a 2% loss. Or nobody ever says 2.39, right? And then people then round off. So the programmers would then go and they would take the different numbers they hear from different people and they would round it off to make it easier. They say, well, this guy said that and this guy said that, and they just round it off. They don't care. They don't care if one guy's a CEO and one guy's like a clerk. It doesn't matter to them. They're just going to round off the two numbers that they heard. So what I realized, though, is that no matter how much you strive to be different, all these programs end up doing the same thing. They'll move to the whole number increments, and they'll trigger certain events at the whole number increments. So if somebody's writing a bullish program, they'll go one way. Someone's writing a bearish, they go another way. And what ends up happening is the confluence of all these programs trading against each other creates these certain lines of resistance. And those lines of resistance generally hit 5% marks, and they generally center around large whole numbers on the chart. So a significant 1,000 line on the Dow is going to be very likely to be a point of consolidation. You don't have to know where the line is. So the 5% part is it's like a Fibonacci. It's like Fibonacci retracements follow the natural growth of a thing. Either the expansion and contraction of things in nature follows something called a Fibonacci sequence in nature. The computers are not natural, so instead of the Fibonacci sequence, they just follow a simple 5% sequence. They'll go 5%, 2.5%, 1.25%, and 0.625%. Or, 0.625%. So that they'll follow these very identifiable numbers as they move as they expand and contract. So all we're doing is following the natural rhythm of the computers as they expand and contract in the trading. And when you're in a market like this where 80% of the trading is done by bots, the 5% rule works incredibly well. And all we have to do is identify the point of consolidation. So let's say Apple Okay, see 90, right? 90, 90, 90, 90, 90. That certainly 90 is a bottom. So if we call 90 a bottom, then let's say we would expect, what's 5% of 90 is 450, right? So that would be 450. So that means 103.50, I'm sorry, not 103.50, 94.50 should look like something. It's kind of hard to tell, but that's here. And 99 should look like something, and that's up here. So it's basically the 100 line. So you can see that the 100 line is obviously also support. And that means we're going to then look at 110. And do we see support along 110? Yes, we do. So now we're seeing what Apple's doing. So Apple's moving in these so the Apple basically, for me, the 90 line or the 100 line is moving in tens. 120 should be another support. And you can see here, especially here, it broke out over 120, went like a rocket. And then 130, 140. Very simple. And so that's what you expect to see. It's very easy to calculate and get an idea of what you expect. And then when you see it conforming to your expectations, that's what happens. And so if Apple goes from 90 to 120, and notice it didn't make 120, but that would be a 30-point move. So our 30-point move, we're going to expect a 20% retrace is a weak retrace. 20% of 30 is 6. And then the strong retrace would be 40%. So I expect to see 120, and then from 120, I expect to see 114, and I expect to see 108. And so now we're going to look and see, and here's the 114 line, and you can see that here, and here's 108, and you can see that here. See the big consolidation on 108? And as you see, when you retrace to 108, now spike down. Oh, you have to throw out spikes also. It's very important, the 5% rule. So you're throwing out the spikes. So you don't pay attention to this loop down, but this is perfect. 107.50 is fine. It's basically the 108 line. You can see it holding up here, and that means that we consolidated here. So you can tell it was going to make a bullish move. It runs back to 120, which is where we expect it to be here. So by holding 108, it made a retrace, but it held the retrace. That indicates it's really going to go to 120, and then it popped 120 and shot up to 140. So now, though, we'd be looking at from 108 to 140 is 32 points. And so that means we're going to now look for a little bit more than 6. Well, let's say you're going to look for a 6-point pullback from 140. It hasn't even done that yet. It overshot by 6, which is also what you would expect, an overshoot. But now you look from 140 to 134, and that's going to be a weak retrace in Apple, nothing to be bearish about. And even 134, 128. So even here, 127.50 or 128, right there, that's going to be a strong retrace in Apple. And you see what's funny about that line? It works out perfectly right here. It failed the first time it tried to get over that line. And that's a strong retrace off the run to 140. And so when you see all these things line up, and then it lines up and lines up and lines up, that's when you know the 5% rule is working on the stock. The more liquid a stock is, the more likely the 5% rule is going to work. Okay, if something's not liquid, it doesn't work, because then it just trades on its own. It will be its own thing. Take off the screen saver and make it longer or something. We're back to 25 on oil. Urgh. That's annoying. How's this guy doing? Oh, he's at 66. I should be able to have that one by now. All right. So, dollar stopped moving up. Gold there, that there. Coffee still dying. Nikkei, not really getting excited about this rally. Natural gas, okay. Gasoline, not really following oil back up. Makes me question this move in oil. I'm certainly not going to add more contracts. I really can't be responsible. I tried this, it didn't work. This is where I added before. So I have to really think about this. NYMEX closes in 30 minutes, and they may have a little spike into the close, and I have to decide if I want to ride that out or not. Annoying. Now the index is odd. The S&P got rejected right at the pink line. That's good. And the Dow is right over. So basically, if the Dow gets back under, if the S&P stays under, I'm not going to get off the Russell yet. So I'm going to wait and see what happens. Okay. Yes, we're hoping for 5250, but that doesn't mean we're going to get it. What is your view on BlackBerry and Qualcomm? I could care less about BlackBerry. I mean, that's an old, it's a dead old company. Qualcomm I like. We have Qualcomm. All we did with Qualcomm is sell the puts in one of our portfolios, I guess in the LTP, and we just sold some puts. I think it made a good bottom here. I don't care. You know, all these things get a lot of press, like the, you know, Qualcomm has to pay BlackBerry. I believe what happened is that BlackBerry overpaid Qualcomm. They paid them some licensing fee, but then they paid them too much. And they had, and you know, you go to court to decide these things because, you know, it's a big deal. It's $1 billion. Like, hey, we paid you an extra $1 billion. No, you didn't. I mean, you know, you're gonna end up in court with things like that. It's very hard to resolve those amicably. It doesn't really change anything. It's really not a big deal. It's just business. Nothing personal, just business. So it doesn't, you know, I mean, it's a nothing thing. I mean, it's nice for BlackBerry to get $1 billion, but what are they going to do with it? I mean, they weren't lacking money. They just lacked ideas to fix their phone. And I'm sure they have their niche still, and they're doing whatever they're doing, but it's not a company I have any interest in. And Qualcomm, of course, I like anyway. Although Qualcomm has a lot of problems because Apple is making a big push to do their own chips. And all their suppliers have problems in that case. Don't forget Apple tried to make their own glass. Apple, we have that glass company, which I forget the name of now, the Sapphire glass, and Apple screwed them over completely and bankrupted the company. But the point being, though, that Apple was trying to make their own glass. They don't want, you know, why would they pay a supplier? Why would they let a supplier profit off their 50 million phone orders or 100 million phone orders in this place? Why should if they can themselves supply something, they will. So they're running around trying to do chip design now. And if they can do chip design, they'll do chip design. And that's why, by the way, that's another reason I think Elon Musk is an idiot. Because if it was profitable to make batteries, Apple would be making batteries. It's a crap business. They stay out of it. Anything Apple stays out of, you have to think it's not probably a good business. I mean, as far as anything to do with their own stuff. Because why would they not make their own things? So Qualcomm, their issue, and every Apple supplier's issue, is that Apple is trying to cut them out of the mix. And then if Apple cuts them out of the mix, Samsung has to. Because, you know, Samsung can't compete with Apple if Apple's making their own chips and they're buying them from Qualcomm for more money. That doesn't work. So it puts a lot of pressure on this sector of the market. There's other good things, there's plenty of other places Qualcomm can do, but again, they're very, very big Apple suppliers. It's always a problem. I don't like any company that's a big supplier of Apple. I don't consider that a plus at all. It's a plus while they first start supplying them, but once Apple's got you in their clutches, they will squeeze you for margin, and they will squeeze and squeeze and squeeze until you give up. And then they'll find somebody else and they'll squeeze them because that's all they care about. I mean, they want the best quality, and they go for the best quality, but they will find somebody else to produce a chip. Like, while you're supplying them, they will shop your stuff to other people and say, if you can match these specs with a lower price, we'll use you. And they know they're doing that. And by the way, Tim Cook. Tim Cook is the guy Steve Jobs used to use to do, you know, he's the one who drove down the prices on the iPods until you can get a freaking iPod for like, what are they, $50 or something like that. You can get an iPod with a video screen. It's crazy. So, I remember when I got my first iPod, it was like $500 or something like that. Now they're like these nano iPods and all kinds of weird things. And they've all got screens. You know, it's like, and they come in, I mean, people buy multiple ones in different colors now. They're so cheap. And what did he do? Because he grinded down the price on every single possible part. That was Steve Tim Cook. That was Tim Cook's job under Steve Jobs. He was the supply chain guy. So that's his whole thing. So don't think he's not going to do that with the iPhone. He's going to screw every single supplier over. So you've got to be real careful with these kind of guys. We do like Qualcomm, though, and when they were down here, we sold puts. So they're back down here. I do like selling the $50 puts in 2019, which are currently... Because it's a good price for them. Even if they're having some trouble now, they'll work it out. They're a good company. Not as good as Broadcom, but unfortunately Broadcom got merged. Well, I always used to say I like Broadcom better than Qualcomm, and it finally bore me out, but now I can't play Broadcom anymore. All right, so right now you can sell the $50 puts for $665. So that's going to net you in for $43.35. Okay, so it's $10, like 20% below the current price, and you still pick up $665 for doing nothing, for not even owning the stock. So that's the entry I like, and I imagine in our long-term portfolio we're probably just about where we are. Long-term portfolio, very nice, 150%. Qualcomm, not there. Did we turn it into a full position? Maybe we did. There it is. Oh, we did. We added the spread. Oh, we sold the $50 puts for $7 at the time. So it's right about where we entered it. And then we added the 45-55 spread. And see, this whole thing is basically net even right now. So it's still a good spread to get into on the Qualcomm. The 2019 45-55 spread is not. Notice I was not very ambitious with my spread. I only picked 55 as my target because I didn't think I knew they were going to have trouble. So I wasn't looking for a big gain in Qualcomm. I took a very conservative spread here, but we only paid $5 for the $10 spread, and then we sold the puts for $7.10. So we net a $2 credit on the transaction, and the worst case scenario is 2 minus 50 is $48. So our worst case scenario is we own 1,000 shares of Qualcomm and net 48. So we still have a 10% cushion from where we are now. And our best case scenario is we make $12,000. I did that math, by the way, on the portfolio tab here. Here's our April portfolio review. Wow, that's big. Control minus. There you go. Here's our April portfolio review. Here's all our portfolios. That's the old one. All of our portfolios, all the positions, and everything that we're changing and everything that we're doing. But when we got to the options opportunity portfolio, because that's more of a learning portfolio, because I do it over at Seeking Alpha for people who are new to options trading. One thing I talked about on each one, I figured out the potential upside. Now, how do you figure out the potential upside? I take the net of the spread now. So in SVU, for example, it's 11,000 minus 65 minus 23. So that's like 9. So let's say it's about $2,500. I did it exactly, of course. But so here's $2,500. Now, what's the potential for the spread? It's 50 times $1.50 is 7,500. So the net of this spread. So in other words, if this expires worthless and these guys are in the money, this is a $7,500 return. The net of the spread currently is $2,500, which means there's a $5,000 upside potential to the spread. And that's how you look at them and decide if you want to keep them or not. So now if we go down to SVU, I missed it. Isn't that funny? Really? After SQQQ. No, look at that. I missed SVU. That's funny. So there's another 5,000. But that's what I was writing. I was writing this on Twitter. I did very disappointing, but we have a low basis, 5,000 upside, 100,000 downside protection on the CZAs, 12,000 profit potential on UNG. So I went through each trade and looked at the potential for the trade, because that lets us know if the market is good and it does what we think it's going to do, how much are we going to make? Are we going to make enough money to make us happy? Now, in this case, it turns out we're going to make $160,000. So, yeah. Okay, between now and the end of next year, we have $160,000 in gains if the market keeps going up. Therefore, if I spend $50,000 of my $160,000 on my hedges, I'm still making really good money. Because $100,000 is 100% of our portfolio from where we began. So that's fine. I'm perfectly happy making that. So even if we're really well hedged and even if we lose $50,000 hedging, that's still fine because we're still going to net 160. And of course, obviously, we're going to add more positions than this. But if we just coast on what we have now and the market stays bullish, we have $160,000 coming to it. You should always know these numbers for your portfolio. You should always have an idea of how much you're going to make if things go well, how much you're going to lose if things go badly. You have to have proper expectations for everything you're doing. All right. Oh, wait. There's markets. You got to check it every 5 minutes, right? Charts. Yes. Okay. Oil stopped going up. You're good about that? Oh, and I could have doubled down on him too, but I didn't. Oh well. So the Russell came down too. So my instincts were right. I don't see any news. I didn't see any reason to change. And so, you've got to be, I don't want to say that you shouldn't change things. You shouldn't get into something unless you have a strong reason to do so. Given that you had a strong reason to do so, unless something changes, you default to sticking with your plan. So you see, before I'll take my move, even though I said I want to set a stop here, set a stop here, I still, when I see a burst up like that, I say, well, why did that happen? And if it happened for no reason, then I'm not going to change my mind. I might even, in fact, change my mind the other way and add more to the downside to increase my basis. But you have to think about why is the market moving and is it sustainable? You don't just get out of things because it crossed some imaginary line that you made up. But and again, I'm saying that I'm not a TA person. This is very important, though. I'm getting into these trades because fundamentally, I believe that there's enough evidence to show me that something should be going down and not up. Gravity. Like, I believe in gravity. If the apple hit me in the head, I'm Isaac Newton. So the apple hit me in the head, and I'm pretty damn sure that every single time that apple falls from, the apple comes loose in the tree, it's going to fall to the ground at 32 feet per second, because I checked it 100 times, and that's what happened. So you know what? If one time the apple falls and it doesn't fall down and it goes sideways, that's not going to make me give up on gravity. I'm going to say, what was weird about that one? What happened? And maybe something happened. Maybe the wind hit it. Who knows? But the point being, if something happens that you don't expect, you don't throw out your premise. You check your premise to see if it's still where it is. So in this particular case, and as often happens in these webinar days, because we always have these afternoon bounces, but as often happens, we go into a position, it goes against us, but that doesn't mean it's wrong. It just means you need to double check and make sure you weren't crazy when you went in or something didn't happen since that time. And since we saw nothing at all that's changed in the news, why would I get out of the position? Oh, even worse, there's a Russian guy talking about how they need to work out a peace with Syria. So that's terrible for oil. I guess it might have been good for the markets. I mean, that's why. All right, where are we? BlackBerry we talked about. TF. Okay, good. That's glad that worked. See, he went up and I went down. It's Tillerson and Lavrov. That's why. Okay, yeah. So that's what it is. So they're all talking nicey. But it doesn't change the picture on the market. I don't care about Syria. I care about earnings. That's not important. Now, it's not good for oil because Syria was the excuse to take oil higher. If you take away the Syria excuse, you got problems for oil. But on the other hand, on the market, it's no reason to rally the market because Syria didn't exist a week ago. It wasn't a thing. It didn't cause the markets to come off. It hasn't been the cause of recent market weakness. Recent market weakness is because things are ridiculously overpriced. You can't create a problem and fix a problem in 3 days and say, oh, now the market should rally. It makes no sense. What's your prediction on gas in the summer? I don't think there's going to be a lot of pressure. The demand for gasoline simply is not there due to the better mileage the cars get. So you're not going to get that really high demand in the summer. It'll go up a bit. I mean, if you want to look at it from, let's not talk about the pump prices. Let's talk about what we have here. So we're at what, 175 on gas? There it is, 174. Okay. So we're at 174. I don't think we're going to get much past 185. Maybe into the 190s. I really don't see $2. I think it starts shorting at $2. There just simply is not the demand. I mean, and again, it goes back to the stockpile. Where are we? There. Motor gasoline stockpile. So you see, we're last year 225. Now we're 235. So let's say, all right. So we're 5% more gas than last year. Okay. Now, how much was gas last year? All right, that's not even last year. It's a 5-year average. I don't know where we were last year particularly, but it's above the 5-year average and near the top of the 5-year range. So we're basically at max gas. But then if you go back and you look at the gasoline, and you go back to last year, we topped out right here. This is where we topped out last year. And we've got more gasoline now than we had last year. There's no reason for us to have any kind of big rally. And you see what happened here? We got rejected. We didn't make $2. We got harshly rejected. That's what's going to happen again. The same thing has happened here. We're going to go up, maybe get close to $2, and then right back down. All right? So figure the same kind of humpy, curvy thing is going to happen. So we'll end up back here after some kind of rally. Maybe I think 185. I don't actually the 190s to me. I think that's going to be tough. I think getting over this area here is going to be very, very tough. So it's just not a good reason for it. And the problem is the AAA and the people who measure this stuff and MasterCard. Well, there's two different things. There's a MasterCard spending pulse that measures the actual purchases of gasoline. Then there's a AAA that measures the driving. Now, AAA is usually on top of things because what they do is they poll people and they ask them, how much are you going to drive this year? They say, what are you planning on doing for vacation? They try to get an idea of how much people are driving. So the AAA tries to get the numbers, and they try to, in advance, say people are going to drive 10% more this year or 5% more this year or whatever. And then they come up with a total number of miles. But the problem is, in the past 40 years, that's always been a great way to tell how much gas is going to be used, right? Because you say, well, they're going to drive more miles, they're going to use more gas. That's no longer true. So AAA hasn't changed their methodology. So that's why MasterCard, with the spending pulse, will go to the pumps, and AAA will say, oh, no, people are driving more this year. And MasterCard will say, it's not showing up at the pumps. It doesn't show up at the pumps because the cars they're driving get significantly better mileage. And the more you drive on the highway, the better the mileage is for these cars. It's not taken into account still by the analysts. Okay? They don't understand the concept that every year, the 15 million new cars that were sold last year, that let's say 5 million of those cars stayed in circulation, they were used cars, and they're somehow still around, but the 50 million new cars, 10 million cars replaced 10 million cars. So 10 million cars that get 35 miles a gallon. By law, they get 35 miles a gallon on the average. So 10 million cars that get 35 miles a gallon replace cars that get 20. So 20 divided by 30. No, it's not that. It's shit. All right. 15,000 miles divided by 35 miles per gallon, 428. All right? 15,000 miles divided by 20 miles per gallon, the old cars, 750. There we go. So 428 divided by 750, 57%. So the new cars use 40% less gas. 40% less gas than the old cars. And we've had 3 straight years of record auto sales, which is why auto sales are tapering off, because we sold 45 million brand new cars in the last 3 years. Of course, you're going to start slowing sales down because half the people who drive have a brand new car. So, of course, they're not customers anymore. That's why everybody's freaking out about auto sales. I'm like, why would you be? I mean, it's a cycle. How could you possibly expect it to always be up? It's ridiculous. You've given everyone a car. It's like, oh, you got a car, you get a car. So everybody's got their car. So now you have to wait for those cars to become old enough that people want to get new ones again. But still, we still have the replacement cycle going on. We have another 15 million cars sold this year. And that's another 10 million cars that are going to get 40% better mileage and use 40% less gas. Then the same guy doing the same vacation is going to use 40% less gas. How could that not hurt the gasoline demand? It's such a massive, fundamental factor in supply and demand picture that nobody takes into account. It's like willfully ignored. It just amazes me. All right, so that's why I don't think gas prices are going to go up. I think everybody's overestimating everything. And they just get shocked after the fact. 5307. Almost feel like I should take that, right? I mean, it's like I'm lucky I got back there. Bob Lutz, GM guy thinks Tesla is doomed. I think, well, I mean, I don't know if I go by Bob Lutz being possibly sound great, but look, I don't know if Tesla's doomed. Although, yeah, maybe I think if Tesla's doomed, it's because the overreach. Electric vehicles are the future. Everything points to that. Electric vehicles are the future. There's no reason to use a gasoline car if you can make an electric car that is just as good. And once they solve the battery range problem and the recharging problem, they will solve it eventually. Once you can go to a gas station and plug into a supercharger that charges your batteries in 5 minutes, it'd be cool for laptops and phones too. But once they figure out how to let you charge up a battery fully charged in 5 minutes, there'll be no range issues anywhere, right? I mean, pull into a diner or pull into Denny's, they jam a little chargy thing in your car and you're done. And you eat some food and go. Just like a gas station now. That's the future. But, it depends on a couple of technological breakthroughs, but eventually that's the future. So that doesn't make Tesla the future, though. Yes, this is a mistake people make. Like printers. I graduated college in '85, and fax machines were just becoming a thing. And I was working with a company that was doing some legal stuff, and we were trying to convince people to. I know it was a messenger service that delivered to lawyers, and I wanted to have an efficiency expert. So we were trying to get the customers to accept faxes. The customers were insurance companies, and we were trying to get them to accept faxes to cut out the deliveries because deliveries were very expensive. The biggest cost of business they had was delivering everything by hand because things had to get there faster than the mail would. So you're either going to use FedEx, which is ridiculous, or you have to do it by hand. So if I could get the customers to accept a fax and commit the policy by fax, and then in assumption that they would get the regular mail copy in 2 or 3 days, that saved the company a fortune. I mean, it was like a huge, it dropped 10% to the bottom line. Gigantic savings. It was such a savings, in fact, that we went around offering to buy people fax machines and give you a fax machine that you can use, and nobody had a fax machine. So we buy these fax machines. They're $1,500 to give someone a fax machine. It was that worth it to it. And we would give people a fax machine, and the people first of all, they're like, well, I can only use it for your stuff. And you're like, no, you can use anything you want. They're like, you mean I get a fax machine? So it's like we're giving away fax machines. And so we would give them the fax machine, and we would, as long as they stayed a customer, of course. And the hardest part wasn't giving them a fax machine. They were happy about that. The hardest part was convincing them that the fax was a legal document. That's how new faxes were. The people didn't even believe a fax was a legal document. So, long story short, though, the point being that at that time, because I went through this historically, at the time, so I was in the early stages of fax machines. There was no such thing as Hewlett-Packard. fax machines were like Pitney Bowes and things like that. I mean, weird companies made fax machines. And we would always be looking for new and better and whatever and so on and so forth. And I saw over time how Canon basically and Xerox and Canon, Xerox, and HP basically took over the faxing market, and then HP took over the printing market like unbelievable. They wiped out everybody. You know, there's a point at which everybody had a printer. When I had my computer in school, I had an Apple printer. There were no HP printers back then. When I was like the early '80s, there were no HP printers. There was no such thing. Well, HP was a calculator company. All of a sudden, HP completely wiped out the printer company. Now, point being, Tesla is an electric car company. Yes, everybody's an electric car company. There's dozens of them. They were a pioneer. That's fantastic. They made the best one at the time. But you know what? The best fax machines at the time were freaking Pitney Bowes. And how many Pitney Bowes fax machines do you see now? You can make the best, the greatest, the most in demand, the best features, everything you want. You can do everything perfectly. You can be the top name in something. But when the market matures, you can get wiped out like a freaking a castle in the sand. You know, just a wave comes by and whoosh, you're gone. So that's where I think Tesla is overcommitting. They're betting on a future in which they dominate when there's no actual evidence that that's going to happen. And when their competition are the mass producers. They have no experience whatsoever mass producing and mass distributing automobiles. And you can't even pretend that it's the same thing to deliver, what do they do, 25,000 cars a quarter. So they're delivering 8,000 cars a month. Okay, so that's like, even if you assume 20 days, that's 400 cars a day. So they're delivering 400 cars a day. That means I could personally, if I'm Elon Musk, I could personally walk up and down the aisle and personally inspect every single car that goes out of my shop. Or I could at least get some people who I really trust to do it, right? 800 cars a day. When you're GM and you're shipping 80,000 cars a day, it's a little different. Okay, you have to have the logistics to run a massive global operation, and you have to do it with a quality standard that you set up. There's no way that Tesla can move up like that. But yeah, and again, that's a good point about the electric, though. The electrics means, infinite mileage. There's no gas at all in the electric. So as those things start kicking in, it's going to kill the mileage. And also as you get these self-driving cars, the ones that are going to like Uber and things like that, they're not going to spend money on gas. They're going to get the most efficient possible cars. And also, they're not going to use as much gas. It's much more efficient. If you have self-driving cars that just pick you up and drop you off wherever you're going, it means your car isn't wasting trips going back and forth. You still have to make a trip back and forth to your house, but there's a lot less wasted time and wasted effort in the car. So you have more efficient cars making more efficient trips, and it's going to be killing the gas industry. It really is. And by the way, people will make less frivolous trips. Because if you have a car, you're going to make a lot of frivolous trips. If you don't have a car, even if it's easy to call an Uber and get it in 2 seconds and have it come out your door, you're still not going to make a lot of frivolous trips. You're not going to go to the store just because you feel like having an ice cream. Things like that. It's like you're going to be like, I'm not going to go hire. I'm not going to call Uber just so I can go get an ice cream at the store. But if you own a car, you don't think twice about it. You go to your car and go grab some. But I think operationally, and this is how I look at Tesla too. Operationally, Tesla is doomed because they're overreaching by a mile. But they're overreaching like a mile because this is how Musk's con game works. This is how he gets you to keep pulling up money to put into his thing. He has to keep showing you new and exciting stuff so that you'll keep giving him money. And if he stops for a second, all of a sudden you're going to go, well, are there somebody might say, gee, Elon, are there any profits? He's like, profits? Look, Hyperloop. Look, Mars. You can't, you can do that for so long, but after a while, people get tired of giving you money for your pipe dreams. So, Arby, when do we go long for the summit event? This is it. This is the last cycle where we're going to be bearish on oil or gas. We're not bearish on gas already, but we're certainly not bearish on oil anymore after this particular cycle. Even if the overhang continues, it'll just make me not want to be bullish, but I'm certainly not going to be bearish anymore after April. Into the May holiday, we absolutely are going to be looking for an opportunity to get bullish. By the way, I got my Bolt. Okay, Disney Range Rover Bolt, small but good. Oh, so you actually got one. That's cool. Okay. Yeah, look, I don't know the Bolt is that. I wrote this article about GM and Bolt, and everyone got confused and thought that I was like the big Bolt booster. I could care less about Bolt. It was just an example to say, look, GM just makes their first attempt at an electric car is already as good as your Model 3, and the Model 3 is your whole fucking company. This is it. They planned the Model 3 for 10 freaking years. They took everything they could possibly do and threw everything into this car, and Chevy comes out with a Bolt, and Chevy just goes, oh yeah, here's a car. Here's an electric car that does all the same stuff. That's why Tesla's in trouble, because that's what the big companies can do. If you have a successful car, they will copy your successful car, and they will put it out for less money. So we'll see what happens when and it's so funny because a whole bunch of people I wrote because I wrote that GM versus Tesla. I got so much bad mail, and people were like just so angry and telling me how you don't understand the Tesla's design and this and that and they're better and meanwhile I'm like there's no actual car. There is no Model 3. It's a freaking it's on a drawing board. There's no actual production of the Model 3. The Bolt is something people are actually buying. Not only buying it, but they're buying it for I think the lease is like $329 a month or something like that. I mean, it's just, it's cheap. Hydrogen. I don't see hydrogen catching on. I think electric's going to. I think I know hydrogen makes sense, but I think that they're going to solve the problems of electric, which are basically range issues. They're going to solve those problems too fast for hydrogen to become an alternative. Because, why bother? If I have an electric car, because I have electricity at home. I don't have hydrogen at home. I have electricity at home. So anybody who has a home, an electric car makes sense. Because all they got to do is plug it in when they get home, and you're fully charged. And frankly, here's the funny thing, because everybody talks about this range stuff. But really, if I topped off my tank every single night when I went home, how often in the entire year do I drive in a day so much that I use up a whole tank of gas? That's like almost never. I went to Toronto with the kids, and I went to Boston, and we went to D.C. And I say, and frankly, Toronto, yes, Toronto, we ran out of gas on the way. I go to Killington for skiing, but I can make Killington on one tank of gas. So I could literally go from my house to my ski house on a tank of gas. So I base plug to plug, and I get to my ski house, I plug it in, I'm done. So I never actually need it. I don't even for that trip, which is a fairly 4-hour trip. I still don't have any range anxiety. I mean, I guess if I got stuck in traffic or something like that, it would be dead. But the point is, it's not like a car, because in a car you don't fill up your car. So they talk about this range anxiety, but what if every day you're full? You start off the day full. Then how much range anxiety can you really have, unless you're going on a really big trip, in which case take another car. If it's going to worry you, Shannon bubble jet. No, there were no bubble jets back then. I don't know what the hell I had. Now printers all the printers practically free, and all you do, they want you to pay for the, it's like a shaver model, right? They just want you to pay for the cartridges. Yeah, I like that commuter car idea. Actually, frankly, if they made a smart electric car, I would kind of like that for an extra car. Because I actually have an extra half a garage. Like one of my garages is a half garage, so I would love to have. I could fit a smart car in there. Right now, it's like 2 Barbie cars that the girls never use. So it's big enough. I could put a smart car in there. It'd be fun to have. And I like something to tool around in like that. Especially to go to the city, because then I could park. And it'd solve a lot of parking problems. Let's cite the cash range, subsidies, and competition. Well, that's a lot of stuff. Only that. No, I cite also though the manufacturing logistics for the car, and probably the solar too. I'm not an expert on solar though. This is the thing. I don't know exactly how the gigafactory works. As far as I can tell, he's never going to have any margins, because how can he have margins when you have Samsung and Panasonic have massive factories in Asia and China and Japan, and they're cranking out batteries to everybody on the planet. And why are you going to be more efficient making a factory in Reno? How are you, I don't see it. And even if you are, they're just going to drop their prices. So that's where I see. So I'm not an expert on batteries, but I am an expert on cars. I know all about car manufacturing. I know the process. I know the assembly lines. I know how it all works. And I'm telling you that he cannot do what he says he can do. And it's all going to start falling. The wheels are going to come off that bus. Yeah, hydrogen. Yeah, well, I mean, look, they'll figure it out. But I mean, the thing is, I think they'll figure out electric faster. There's more people working on it. Oil didn't break below 53. Oh, what's going on? Yeah, I should pay attention to these things, right? If I lose all my money. No, that's not so bad. Ugh. I'm not going to go to sleep, with 20. I'm going to cut back to 10 again. But we will see what happens. Did I miss your thoughts on my comment about what do you expect from bank earnings this quarter? They releasing results. I think the expectation, yes, we're going to have results tomorrow, so it's going to be an interesting day tomorrow. I think the bank earnings are going to disappoint because how could they not disappoint when everybody's expectations are so high? I know they pulled back a bit, but XLS. So yeah, they've come back quite a bit, but the bottom line is still we started at 19 and we went to 25. That's up 6, which is like 30%, right? Yeah, 30. Yeah, about 30%. So we went up 30% from here. Now we're at 23, but 23 from 19 is still 20%. Okay, we pulled back a good amount, and that's why, by the way, that's fantastic. That's actually helping the short-term portfolio a lot because we have those short, fast positions. But I think we're going to end up back here. I think we're going to be back at 21. And the more they put off these regulation changes, I mean, look at that. Look at that line. And here you go. Here's a 3-year chart where you barely ever get over that line. And when you do get over that line, you generally get punished at some point. But here, we've been like way, like 1, 2, 3, 4, 5 boxes. 5 boxes, 6 boxes, 6 boxes over. Here, you're like 2 boxes and it corrects. That's not good. Okay, we're way, and look at this thing too, way overboard, just ridiculously overboard. So unless they have some spectacular earnings, I think we're probably going to see the banks sell off and disappoint a bit. So by that rationale, since fusion power couldn't work before when then it can't work now. Yeah, well, okay, I agree with that. Right? It will work eventually. It's just a question of when. But like I said, though, I think the economics for electric are already there. The range anxiety thing, I think, is something that basically the fossil fuel people like to say because they just don't want people converting to electric cars. They create, just like the election, you create anxiety in the buying population that doesn't exist and shouldn't exist, and you make it into a buzzword so that way people are hesitant to buy electric cars and slows the adoption process down. That's what it's all about. It's really it's a problem, or it's a term in search of a natural problem. But still, obviously, look, people run out of gas too. It just happens. So we'll see. And hydrogen doesn't fix that because you still have to put hydrogen in your car. So what's the difference? The only thing about hydrogen, though, I think it's hydrogen it has to substitute into trucks, which is also going to, by the way, when you do start doing it, that's true. I don't think electric can power trucks. I don't think it's likely to in the near future. I think hydrogen has a better chance of powering trucks. And when you start powering trucks, holy crap. Oh, oil broke? Ah, yes. Really? Make my day? Yes! All right, so now 53 is my stop, if you guys pay attention to me. 53 is my stop on the 10 because I made 25 times 10 is $2,500. So I basically picked up an extra $2,500, so there's no reason to throw that away. And it's just like bonus money. I didn't need the money. It was just something I thought was going to happen, and now I made it. So at this point, I'm going to crank up the other machine in case I can use both accounts. This is just my sample account. I don't really, actually, it's not my actual trading account. This is because I needed an account for the webinar, so I set one up. Oh, so this is good sign. See that breaking? That's a good line to break because we have this little resistance line here that's falling apart. And if he keeps going down, that means he's probably going to lose his line at 52.90. And if that happens, all hell can break loose. All hell would be very, very profitable, actually, if that works out. This is a 50-point drop. At 50 points, that's $10,000 bucks. Yeah, 50. That'd be another $10,000 if it happens. But I'm certainly not going to count on that. But notice that the NYMEX closed and it started falling apart. So the NYMEX is holding it up, but as the trading thins out, this thing is falling apart. So people who have to sell and get out of those bullshit contracts, they're facing a lot of pressure. And this is not going to get any easier. It's going to get worse and worse as the days go on. Although today, technically, we're selling all day. From the open, selling. So all day today was selling. The question is going to be how many contracts did they manage to get rid of? And we'll find that out tomorrow. They're probably going to be writing about this tomorrow. Like how many contracts in a total day of selling, how many contracts did they manage to wriggle out of on the NYMEX? All right. So meanwhile, I'm going to take credit for this because when we started the webinar, we were at 52.25, 53.25. Now we're down here at 95. So that's $300 per contract. Very good. So $300 a contract. I did 10 contracts. That's $3,000. Very good. And hopefully we can do a lot better. If this thing collapses, I will be happy camper. I'm going to stare at it. Staring at it doesn't help. Not looking at it at all seems to be the way to go. But do tell me if it starts bouncing back over. Oh, dot matrix. Yeah, I remember those. Yeah, the fax machines. No, they were thermal. Remember thermal? Those were awful, and they would fade over time. They would just. That's right. That's for our purposes. I was working with the insurance company. They for what they were doing, it was perfect because they just needed to give you the form, show you it was fine. It's like saying, take my word for it and start the policy process. So you get a 2-day jump on the policy process. Then they would follow it up with the hard documents that were properly signed. But just taking the messenger out of the equation was incredible. But yeah, the thermal sucked, and it curled up, and they think it would go under the fax machine, like the paper would start curling in on itself as soon as it came out of the fax machine, and if it fell off, it would roll on under the fall. You have like a little catching area for the papers. Too fun. We talked about bank earnings, talked about Fusion Power, which is great. Lockheed Martin, by the way, we have Lockheed Martin long because of Fusion. They're the guys who are going to put it together. Why not put NAK in the OOP with that news today? Because it's not, again, it's like, okay, the OOP is a portfolio I mirror over at Seeking Alpha. And to me, those people are not as knowledgeable. They're not like, and a lot of them are not high net worth people. Like most of the people at PSW are more high net worth. It's too risky. It's on the risk spectrum. It's above where I like to be on the risk spectrum for what I try to make a conservative portfolio. I want the OOP to be like an intro to options portfolio where I put in very, very high probability trades. And yeah, sometimes they don't work out, but I mean the point is I'm putting in very high probability trades, and I'm trying to pick things that we have very good fallback positions are. There's no fallback to NAK. If it doesn't work, it's junk. If this thing goes wrong, if they end up getting denied on their thing, it goes bad. I love NAK. My kids have NAK. For them, I can risk it, but I'm saying, but as a straight, my kids have had NAK since 50 cents. That's just, it's a good little stock. We sold most of it. We sold half of it when it went up, and now we're, so we just have we have a zero basis basically in NAK, so we'll see what happens. it's always been like a thing that if it goes well, if they actually get a partner, if they get the permits, which is much more likely now that the EPA doesn't care, then they're sitting on a massive gold mine that they can strip mine the hell out of and destroy the environment and kill that region and turn it into a wasteland. But meanwhile, there'll be lots of gold, and copper and moly. So it's a really good mine, but it's an environmental catastrophe, which they're going to get approval for. But anyway, but it's not something I would really put in the OOP. It's tempting. If it had gone down to $1, I would have probably done it, but it didn't. I've actually been watching it and hoping it would come back down to $1. So, we sold here at when it went over 250, we got out because we were like, 250? You freaking kidding me? And then it came back and it didn't quite hit $1. And this is my bad because I was greedy and I've been watching and hoping it would come back to $1. But now they got a permit and I don't think it's ever coming back. That's why I put it up as a trade today in the member chat. What was that trade on NEK? More than. Okay, so the trade idea we came up with today in chat was they actually have options. You can sell the November 150 puts, probably not now because it just jumped up a lot, 23%. You can sell the November 150 puts for 60 cents, and then buy the 1-2 spread for 45 cents. And if you sell 50 of the puts for $3,000, and you buy 100 of the spreads for $4,500, then you have a $10,000 spread for $1,500 net, and the worst case is you get 5,000 shares at 130. So your worst case is you'll spend $6,500 to own NAK long term, but if it goes well, you're going to make $8,500, and all it has to do is be over $2, which I think is a shoo-in on this thing. So that's the kind of spread we set up in the member chat. But again, it is risky, and the PSW members are the kind of people who understand the risk and are willing to say, okay, well, if I end up stuck with $6,500 worth of stock, that's no big deal. I don't take it that the OOP members are as cavalier about something as that. So I try not to pick trades where that's even a possibility. SKF, what's that? The Ultra Short Right Financial? I'm not that. I don't know. I just think that they're going to go bad. Well, I say that, but meanwhile, we do have an incredibly large short position on FAS. See, what we did, which now looks smart, didn't look smart before, but now it looks smart, is we shorted FAS. I'm sorry, we didn't short it. We were originally long on FAS, and then we had a leftover leg. And so we deconstructed the spread, and I bought back the short puts for almost full profit. I sold the long calls in the spread, and I left the short calls. So we cashed out when FAS was way at the top. I don't remember where it was, but let's see. And you know me, I like to sell premium, so I'd rather sell ultra calls than buy the ultra short. So yeah, it wasn't here. When did we do that? I guess it was in November or something like that. So somewhere around here, getting up around here, we deconstructed the spread. I think maybe when it popped around 40. We took the money on the long part of the spread, and we left the short legs, and I figured it would sell off. Then Trump comes in, and instead of it selling off, it's lasted way up here, and now it's finally calming down. So that's why we're short on FAS. So we weren't intentionally making it a short play, but I left it as a leg that I figured would eventually calm down. And so we have the short January 37s, and we're at 43. I think we might get back to 40. And if we get back to 40, this is 9 now. This thing could end up being like $3. I'll be thrilled. I'm thrilled with this because we were down about 30,000 at one point. So just being up a little bit is fantastic. And we don't need it, but it's technically it's acting as a hedge right now because we owe 46,000. If the market does collapse, then we'll pick up the 46,000. That's more insurance for us. All right, I got to wrap this up. Last couple of questions. All right, wait. Total net fusion, blah, blah, blah. Okay. Okay. What point do you throw the towel on coffee? I don't throw the towel on coffee because I don't expect coffee on any particular day to go up. I expect coffee in the summer to be higher. And if not, it's still a long-term global warming premise for us. So we don't think, it's not about throwing in the towel. We just happen to have a bad day, probably because there was a bullish crops report. I didn't even bother looking. But it's an erratic thing to trade. That's just the way it trades. I think it'll be at least over 150 in the summer. So I just want to be in it constantly, and we'll see if it bumps back up. You see what happened here? We're in April, and you've got, even here, we had a bad thing in May, right? And then you got June, July, and see how it starts picking up nicely. And then by the end of the year, it was way up. So we're just waiting for another little demand swing to come back in and some more bad crop reports. The bad crop reports, because of global warming, the bad crop reports are not the south of the equator crops that are reporting now. Those guys are having good crop reports because of global warming. The bad crop reports, just like last year, good crop reports because of global warming. The northern hemisphere is where you get the bad crop reports, and that shit sends the price skyrocketing. And meanwhile, there's no problem with demand. Demand is through the roof. So I'm sorry, what happened to SKF? We never really finished that discussion. Who was that? Oh, well, unless somebody said the word SKF. But the bottom line is you could play SKF. I'm not particularly into that. But let's talk about it just in case. So SKF is an ultra short. The thing is, I have no conviction that the banks will go lower. I just really think they will. I think that they're certainly overbought. So you could play SKF to be up around 35, and if you wanted to do that, the way I would play it is probably, I don't want to own, if it goes the wrong way, I don't want to own SKF. So I'd probably just go for like a bull call spread, and you're going to do it into earnings. So May, and we said, what we say target is 35. Well, these are very forgiving numbers. Looks like you can get the 28 calls for maybe $1.60, $1.70, and you can sell the 30s for at least 70. So you net $1 on the 28-30 spread. So it's basically you get 100% gain if it just goes over 30. I would leave it at that. I mean, if I can make 100% in a month with no margin at all, that's the way I go. So basically, the 28-30 spread for less than $1 is the way I would go. And then you have 100% upside. You're already over $1 in the money. So it's a real easy way to play the financial bearish. And it would take almost nothing for you to get to 30 and have a nice profit. So NAK will never be a mine. I don't agree. I think that it will be a mine because there's gold there, and there's very name all the gold reserves on Earth that have not been mined. It's a very short list, right? I mean, and especially accessible ones. I'm not talking about I'm not saying it couldn't be mined because it's 50,000 people of the Earth. I'm talking about wasn't mined because somebody put up a poster and said protect the stream. That just doesn't happen. It's the relentless drive of the people who want the money will overcome all government resistance over time. Just like the pipeline. Look at the pipeline people. They're like sacred burial ground. Screw you. We're going through there. And all they were asking them to do, all they wanted them to do was to make the pipe a little bit longer and go around their lake. That's all they wanted was don't come through our lake. We don't want you to spill oil in our lake. Go around our lake. They're like, no, we're going through. That's what this whole thing was about with the pipeline. Insane. And now that Trump's in charge, forget it. I mean, I don't know what you think is going to stop these guys. Russell is below 1262. Will it continue down to 1250? Well, I sure hope so. That would give me a perfect day. I love perfect days. Oil stopping a little bit. Russell. Oh no, I don't like the way these guys are bouncing. So I'm going to get out of my Russell trade. I'm going to get out of that thing. Active trader. Look, I mean, $50. Let's see if I can be greedy. Let's see if I can get that. Can I get that price? Nope. Oh, as soon as I put it in. You bastards. Take it away. Watch, I'll take it away. See? I took it away and it dropped. Now they're fishing again. Now I'm going to get the price I wanted. Nope. Look at how it bombs. See, these are all fake. If it was real, that wouldn't happen. Look. Now they're trying to get me to go up. I'm going to take it away. It's going to drop again. So 61.7. 61.8. Maybe not. Uh-oh, 61.9. Oh, come on. It's not fair. Mm-hmm. Huh? 8. 1. 8. Yep. Nope. Mm. Really? Oh, there we go. Thank you. You just got to be more patient than they are. It's such a farce. It really is. All right, so $50. I don't care. $50 is good. 14,000 is even better. That's good money. So, we want to watch Brent and see if this 55.60 holds, but don't forget we're going to close NYMEX soon. Well, 3 o'clock, we've got a while. Not close NYMEX, sorry. The contract will close. The problem is tomorrow is the weekend, essentially. I don't think it's really worth risking this kind of gain overnight. So I think before 6 o'clock, I'd want to wrap this thing up. I just, it's not, it's going to be not the best time to do it otherwise. So, in fact, lighten up. Well, no, I'm not putting a stop. So here I'm going to take 5. Okay, so now we're 5 down. Now we're only 15 short, and if we go back over this line, I'm going to get out of all of them, I think. So I'll do another 5. If we get down here, if we get down in this range, I'll do another 5 off, and I'll tighten my stop up to 80. Because, come on, while we've been talking, this thing's made, I don't even know anymore. A lot of money. Where we go from 25 to 85 is 40, is $8,000 while we've been doing the webinar. So, how greedy do you want to be? I'd rather make some money and be done and walk away and then just go out and have fun and not even think about it, and then come back and see where the setup is next time. There's always a setup. There's always something to trade. When you learn how to trade the futures, if you're not locked into any one thing, you can just look at what seems exciting and what seems interesting to trade and find out about it. Now, I'm not suggesting you do it if you don't understand the thing you're trading, but it's not that hard to learn these things. There's some very basic principles that run them. You can see these patterns forming. You can also get, and the fundamentals are pretty easy to check out. In fact, it's better than the market because you're not depending on some random company to do something. You're betting on the total demand for oil in the world. So there's not that many variables here. Of course, some OPEC guy can say this or that, but the reality is there aren't that many variables, and it's not like some random stock is going to jump 40% on you. Plus, you don't have the fees, you don't have the hassle, you get back to cash at the end of the day. There's so many advantages to trading futures. So here, we're getting the breakdown of one. See how he broke down here? That's a great sign. That means we're very, very likely to lose 52.80. And if they lose 52.80, we're on our way to 52.50. That's very exciting. Also, you see 69 short, 69 sellers, 24 buyers. That's not a good sign. And see how fast those buyers start to shoot up? 13, 61.28. Even as I said, though, I went the wrong way. Nope. 56.40. More buyers are coming in. 38. Ooh, they're pushing. Somebody's trying to get it up. No, but he's below. As long as he's below this line, I would stick in this trade. So as long as Brent's below 56, 55, 56, 60. And obviously this is still the stop though. Now this is a stop for sure, this 52.92 line. All right, gonna have to wrap it up, guys. Tesla under 300, fantastic. Boy, what a great day. What level CL will make for a good long position? I don't know. I don't do that. I mean, if it hits 52.50 and it stays, so like through the, I wouldn't go long until after the rollover next week on the 20th. But once the rollover hits, then or if we get a really good spike down, I'm thinking 42.50 will hold. But if we go, not 42.50, I'm thinking 52.50 will probably hold. But if we get down to 50, that becomes a really good, interesting long line. But I don't like to do that. I like to watch it and see what becomes support rather than predict support in advance. You want to see what actually happens. All right, fantastic. I've answered all the questions. It is 3 o'clock. I must come to a close before the recording thing explodes. Thank you all for coming, and we'll do it again next week. All right, take care, everybody.